Hello, everyone. Good evening. Welcome to your market update for October. I haven't seen you guys in a while. Miguel Castañeda, the other Miguel, was hosting this webinar, giving you guys updates about the stock market due to the fact that I was getting married last month. A lot of clients have been asking me how was everything. Everything went well, way better than I expected. We had a great time. We had a beautiful wedding. My wife, I could say that now, my wife and I, Diane Rodriguez. But Today is going to be a very interesting topic. We're going to be talking about the stock markets. There's a lot of things that are going on in the stock market. There's a lot of good insights that I want to tell you guys about. But just like always, just before we get started, just a little bit about me. I'm one of the senior wealth advisors here at Guerra Wealth. I've been here already for around 5 years, if I'm not mistaken, 5, 6 years. Time flies when you're having fun. And I'm just blessed to be the speaker today, letting you guys and teaching you guys what is actually happening in the stock market. So, little bit about us. Guerra Wealth Advisor, we're a full service financial planning firm. We hold our clients' money at Fidelity Investments. So for the people that don't know us in that sense, because we have clients and we have new families watching this webinar, we hold our custodian is Fidelity Investments. That's where we park our clients' money. It's not like you give Guerra Wealth Advisor your money and they actually hold it in house. That's actually legal. Don't ever do that in that sense. And make sure you have a regulated custodian. And that's our custodian, is Fidelity Investments. Now, here in Guerra Wealth Advisors, we don't only do investment management. Today, we're actually only talking about that one area, which is assets under management and stock market and all these different things. But we do way more than that. So when clients hire us, it's for five main things, which is retirement planning, making sure you have enough money to put you in and out of retirements, having the right strategies to supplement your lifestyle once you get to that stage in life that working for you becomes an option, not an obligation. Number two is what we're actually talking about today, which is investment management. Make sure your money's in the right places because due to the volatility and how things are looking like today, you have to make sure your money is in the right buckets. Number three is my favorite one is tax planning. It's not how much you make, it's how much you keep. So asset location, meaning where is your money growing is a big deal. And we look at basically a client's tax returns and see how can we lower that tax bill at the end of the year by implementing several strategies. Number four and number five, they correlate with each other, which is asset protection and estate planning, meaning God forbid something happens tomorrow, a big something catastrophic in your life, that your money goes to the right people, having the right stipulations within your trust so the right persons get the money how you want them to get the money. But other than that, our families, the way that we serve them, we do extensive planning. It's not like, hey, Miguel, here's your money, and then we will put into the best investment. That doesn't really exist. We go through an extensive planning process. So for the families that we onboard, we do what is called the Guerra Freedom process, meaning we look at the 5 areas of financial planning and we're going to evaluate them. We're going to give you a grade based on how good you're doing, or maybe the areas where you're facing some challenges. And we're nice people, we're never going to fail you. The idea of you seeing this is so you can see where do you have more opportunities to basically improve everything that you're doing right now. We'll look at the structure of everything, the status of how you're doing things, and basically the impacts, how basically we could improve your current situation. Then at that point, hey, it might make sense to hire a financial planning firm like Era. Now, topics for today. Let's get to the fun stuff. So today we're going to break down what is actually happening with the market, what is the performance that we're seeing across all the different sectors, and also we're going to be talking about key indicators. What is inflation telling us? What is interest rate telling us? What does history tells us? That what can we expect with the market over the next 6 months to 12 months? And what has the market performed in times like now throughout history? And we'll also talk about opportunities. When there's different risks, there's also different opportunities. How can you basically take advantage of everything that's happening right now and make sure you're making money in the meanwhile as well? So it's going to be a very good webinar. I'm very excited for it because there's a lot of things that we'll talk about. I will answer a couple questions. And as well, we're not going to be spending a bunch of time today. It's going to be around 45 minutes. And let's get started. Now, let's zoom out for a second. I know a lot of families want to talk, hey, the market today, October. Let's look how the market has done for the year. So here in this visual, like we always do, we broke down the market across different sectors and across different indexes. So what we're looking at right now is the S&P 500, the basic benchmark of how good the economy of the United States is doing. That's the one on top. The second one, we're looking at the NASDAQ, which is basically the top 100 tech companies in the US. And lastly, we're looking at the Dow Jones. Now, When you zoom out for the entire year, January 1st of 2025, all the way until now, there's several families that tell me, Miguel, the market is not doing good. Well, I'm not sure how your portfolio is structured nowadays, but when they come sit with us, they might not see the portfolio moving due to the fact that their money is invested in the wrong vehicles, in the wrong financial instruments, and they're lagging behind. And it doesn't mean that you have to take more risk to make more money. You have to make sure your money is parked in the right places with the right purpose. What is the purpose behind this money? Because look at this. The S&P 500, even through the volatility, the ups and downs that we've seen this year, is up 13.93% year to date. It's done very good. And that's going through tariffs. If you guys remember, back in April, we saw a major downturn in the markets. Now, if you held and you went through that volatility and you didn't do anything, your portfolio, if it was tracking the S&P, should be around up 14% more or less. Look at the Nasdaq. The Nasdaq is up 18% and the Dow Jones is up 9.56%. Now, let's not get too excited. Miguel, let's put all the money into the Nasdaq. That's not really a plan because you're investing all your money into one specific sector. The idea behind this is so you could see, even to the volatility, how the market has done. Because depending on what channel you're watching and putting politics aside, either it's going very good or it's going terrible. So you have to understand how is your financial plan structured and how is your money invested today. That's the number one thing you need to do. Based on your goals, where is your money parked today? And what are the opportunities and the ways that you could improve your money how it is today? Now, let's zoom out a little bit further. Let's look at the last year, from October last year to October of this year, a whole year in that sense. When you look at the S&P 500, over the last year, it's up 14.49%. Look at the Nasdaq, almost 22% positive over the last year. And the Dow Jones is up 8.55%. And look at the volatility here back in April. The ups and downs, they're always going to be in the stock markets. You can minimize the ups and downs of the market, the volatility behind your portfolio, depending what instruments are you using as part of your financial plan. But first, you need to create the financial plan and you need to have an understanding of what is the purpose of this money. Is it appreciation? Is it capital preservation? Is it income? Is it a mix of both? Where are you in life today? Now, let's zoom out a little bit even further when you put the noise aside and you see how the market has done over the last 5 years. When you zoom out, look at the S&P 500. It's up 93% going back to 2021. And look at this right here. From 2022 all the way to the ending of 2022, when we saw inflation as high as 9% and interest rates were going up to basically mitigate inflation and bring it down, the market went down. And then from 2023 all the way until beginning of this year, the market rallied. But then tariffs hit, the market went down. And then basically tariffs were delayed with China and all these different conversations that we'll talk about today, the market went back up. So when you zoom out and you see how the market has performed, you could see that the market, the S&P 500, has done over 93%. So when people say that the market hasn't really done anything over the last 5 years, that tells me a lot how the money's invested. That tells me, and it triggers like a whole red flag. Where is your money invested? What do you mean your money has not gone up over the last 5 years? That's concerning because your money, if it did not grow over the last 5 years, we had a pretty decent markets. The market has done very good over the last 5 years. It just depends on the amount of risk that you're taking. So you have to evaluate what are the instruments that you're using within your portfolio. So putting the noise aside, you could see all the fluctuations within the markets, and that's always going to be there. There's always going to be a new headline that's going to come out that might make you uncomfortable, and you have to make sure your portfolio and your financial plan is structured the right way according to the risk tolerance that you have the right buckets in place. Now, let's get into fundamentals. Look at this. I'm a massive fan of this visual. When we look at the S&P 500 and you look at the returns, the total returns of the S&P 500 going back to 1928, 73% of the time, the market goes up. Can you believe that? When I tell that to some families, their mind is blown. And when you really think about it, 27% of the time, the market goes down. So you're diversifying your money to prevent your money to go down for 27% of the time. That's actually mind-blowing. So most of the time, the market goes up, but these red times that you see right here could be catastrophic. So if you're about to retire, let's say, and the market goes down 20%, which is, let's call in this bucket right here, that could delay your retirement dates. That could mean that you lose too much money and then you have to delay retirements. You have to keep working. So that's why we're not pessimistic. We just have to make sure that the plan is in place according to your goals. But this is an amazing visual. It's I'm not emphasizing it enough. 73% of the time the market goes up. You just have to make sure you're taking the amount of risk according to your goals and your portfolio is in the right places. It doesn't mean all your money should be in the markets. It depends on your goals, but that shows you that the ups and downs are always going to be there. Now, let's look at this. Miguel, the market is not doing so good this year, and it's funny because back in the middle of the year, if you guys remember, I had the luck that every single time that I would speak, the market was going up. That streak is gone because the market actually went down today. So if I'm so sorry about that, we don't have the crystal ball. We're now planning these webinars specifically when the market goes up, so the streak is gone. Now, look at this. The market is has hit all-time highs 33 times this year. Through all the noise that we've seen throughout the year, the market has actually just kept going up and up and up. It does not mean it's only going to keep going up for the future. It means that we have to be cautious and how is your money invested today? Because if you look at last year, the market has gone up, had 57 all-time highs. A lot of all-time highs. This year, the market is doing very good as well. But as you guys might know, the market works in cycles, which we'll talk about that now in a second. But this is very good, guys. The market has done amazing this year. So if you're one of our clients, check your accounts. The accounts are doing great over the last couple of months. Now, depending on the date that you look at it, you're going to see red or green. But zoom out for the entire year and look at your portfolio, how they have performed. Now, when let's look at the stock market itself, let's break it down. Let's look at all the different sectors, how they have done for the entire year. Now, the stock market has hit all-time highs over 33 times this year, but let's look at the specific sectors that have caused that to happen. Technology and information, as we've been speaking about all this new artificial intelligence and all this new innovation, those sectors are up over 23% for the year. That does not mean that all your money should be in tech. That shows you that you should have maybe a good portion of your portfolio just following the trend of technology. But there's a lot of fears behind that. When you look at the markets and the way that it's set up today, technology, and there's a lot of fears. Miguel, is the dot-com bubble going to happen again? No one has a crystal ball. You could prepare for a worst case scenario and make sure the risk is spread out within your portfolio. Now, what we have done for our families, we have spread out the risk within the portfolio because we do see that the market works in cycles. And for example, utilities. This is a sector that's very boring. But look at the year to date, it's up 19%. That's something that we've been talking to our clients. Historically, when interest rates go down, that sector goes up. So look at the last month, how the sector has performed. It's up about 7.28%. That's been a conversation that I've been having with the families that I serve on a constant basis, on a quarterly basis, because we meet on a quarterly basis to make sure that your goals haven't changed and also to see if there's any opportunity that we could implement into your financial plan. And it does not mean only the portfolios or money. It could be fiscal policy, what's happening with taxes, what new tax law has come out that we could take advantage of and implement it to your financial plan. As well, estate planning, reviewing your trust on a yearly basis is very important, just as the stock market. Now, utilities is a very good sector over the last months, as you've seen here, mainly because of interest rates going down. And for the year, it's a third best performing sector. That's what is called a defensive sector. Well, historically, throughout recessions and volatility, that sector tends to go up. Why? We have to pay the light bill. As I joke around with the clients, hey, Sebastian has to pay for the light bills. So those companies that follow that sector, they're always pretty steady in that sense. You're not going to be hitting home runs in that sector, just like technology in that sense, but you're going to be hitting singles and doubles. And that's a good part of the portfolio. Now, something that's concerning. Lots of the gains that we've seen over the last couple of years is due to artificial intelligence. So there's a lot of concentration in the markets. Just going back to that, you have to make sure the risk within your portfolios that are in the risky buckets, it's spread out. Now, earnings have come around and then the economy is slowing down a little bit. But with interest rates going down back in September, which was very good for the markets, because when interest rates go down, the market tends to go up. Why? There's more money being injected to the economy. Small size companies, which they have been struggling over the last couple of years, are going to get more access to capital. Business owners are going to be able to go to the bank, get more loans, to basically invest into the business, hire more employees, create more innovation, and so on. That would stimulate the economy. Now, that could be concerning. If they lower interest rates too fast, that could cause inflation to go up. And if inflation goes up, interest rates will have to go up to ease inflation. And that's concerning. That could cause the market to have a drastic downturn. Now, going back to the sectors, this year has been a year for artificial intelligence. We have taken advantage of artificial intelligence and that sector. But just so you guys know, for the families that are not clients, you could take advantage of all the boom through artificial intelligence, not only to invest directly into that sector. There's other sectors that the effect of artificial intelligence trickles down and they get benefited by all the boom in that sector. So by investing, so follow this here, by investing into other sectors that get benefited by artificial intelligence, you're spreading out the risk. So keep that in mind. Now, so going back to concentration. So the Magnificent Seven, you guys have heard of this, the seven best stocks in the economy that have done amazing, that have had an amazing return over the last couple of years. But look at this. There is a lot of concentration when you see this. Back in April, when the market went down due to tariffs, look at the orange, which is the seven stocks, how they went down based and they touched 25%. So if all of your money was invested into only seven companies, your portfolio went down 25%. And then the bounce of the markets, they basically have kept up only with the 493 companies that are inside of the S&P 500. If your money was spread out in that sense, look how you minimize the downside in the markets and you almost end up in the same place. So you have to make sure that your money is invested in the right place, that you're not only following all these hype companies that you believe you see all the volatility and all the fluctuations, you'll be making more money in the actual stock market. That's not really how it works. Make sure your portfolio is in the right places. Let's not make sure we put all the money into the next big tech because that's how you could lose everything. You could make a lot of money, but depending on the stage of life that you're on, you could lose a lot of money as well. Now, let's talk about market sentiments and risk. So going back to risk, next year we have midterm elections. Historically, the market works in cycles. During midterm elections, volatility spikes up. The market doesn't know what's going to happen with elections. Is the other party going to be elected? Will that affect fiscal policy of the current party that's controlling everything? So if the other party gets elected, fiscal policy, basically the laws they're putting in place could get delayed, might not get through, and that creates fear in the stock market. That's why you see here on the top, volatility spikes as you're getting closer to midterm elections, where historically you see the market going down. So if we go back to this visual back here, 2022 was also midterm election year. There was a lot of things that were going on back in 2022. Interest rates going up, inflation was high, and also the market cycle was hitting that time of midterm elections. Now, in midterm elections, you have to make, in a year such as that one, you have to make sure your money is balanced. What do I mean by balance? The risky bucket has appreciated in value tremendously over the last couple of years. It might be a good time for you to sit down and analyze, hey, is it the right time to lock in gains and shift it into a more, let's call it capital preservation or lower risk, let's call it positions and part of your portfolio? It might be a good time to talk about that. Because look at this. When you look at the graph at the bottom, look at midterm election years, how the market performs. It's not so good. And look at all the other years on gray. The market tends to do a lot better. Now, after midterm election year, the market tends to bounce. So you have to make sure you're in the right places, that if the market does happen to bounce, you're taking advantage of that appreciation within the market. So, Miguel, but if the market goes down, I could just ride the wave. It depends. It depends on the need and the purpose behind all this money that you have right now. So risk reward is a big deal. Can you be making more reward by taking less risk within your financial picture? It's a massive deal nowadays because the market, the way that it's looking, is very volatile. And there's a lot of things, a lot of good things that are going on, but there's a lot of unknown. So good things, interest rates are going down, inflation is going down as well. Why do I go like this? Because every time I say to my father that inflation is going down, he wants to throw something at me. I was like, Dad, Miguel, when I go to the store, everything's so expensive. Well, does not mean the cost of goods is going to go down. It means that moving forward, the cost of goods is not going to go up as fast. So inflation has been going down, interest rates are going down, but also we have an unknown, tariffs. Tariffs right now, it's very unknown. We have to be careful with it. You cannot be too over leveraged and too exposed because of tariffs. This that's happening right now has never been tried before, so you have to make sure you're in the right places. It could work, depending how you're looking at it, it could work, but it could backfire. So you have to make sure that you're also spreading out the risk in that sense as well. Now, let's look at inflation and interest rates. So right now, for the next Fed meeting, there's a government shutdown right now. If you guys didn't know, the government is shut down. Right now, we have the second longest shutdown in the history of the United States with the government. And that could affect basically how the Fed reports the how they make decisions. Why? Because they depend on jobs report, inflation data, they depend on unemployment reports. All of those things come from the government. So the Fed right now, there's a lot of fear behind that. But this tool that we have spoken about in the past is called the CME Fed Watch tool. It looks ahead in time to see what is the market thinking that is going to happen with interest rates. And as of right now, for the next meeting on the 29th of October, there's a 97% chance that rates will go down again, another quarter of a percent, which historically, as we've spoken about, is good for the markets. But again, may something happen from now until the end of the month? Absolutely. A lot could happen. And there's risk behind that, as we've been speaking about it over the last couple of months. If they cut down interest rates too fast, that could cause inflation to spike. So there's a little bit of fear behind that. That's where you see a lot of tension between Jerome Powell as well as Trump. They're kind of like go back and forth with each other because Jerome Powell wants to be cautious with the way that he lowers interest rates to measure inflation. Trump wants to basically lower rates as soon as possible because he wants to stimulate the economy. He wants to inject more money into the economy to create more jobs, just more money in the money supply, which historically is good for the market. But there's risk and reward behind each of them in that sense. Now, this is a very good visual on the left. If you see here in the left, that's what the market is pricing, where are rates going to be towards the ending of next year. As you can see, rates will keep going down little by little, around a quarter of a percent every single time. That does not mean that if you go refinance your mortgage, you will be paying 3%. That's not really how it works. And that could change tremendously if a bad report comes out and it gets delayed or there's not rate cuts or there's a rate hike in the other hand. But that's what is the market pricing in right now with rates. There's going to be a slow decline of interest rates, which technically, historically, is a good thing for the market. Now, what does that mean for your pockets? Well, when you go buy a car, interest rates, when you're financing a car, they get cheaper. When you go buy a house, interest rates behind that technically get cheaper as well. But again, risk reward. Now, this is a very good visual. I love this chart. So, what happens to the market in a cycle where rates are going down 12 months after the first rate cuts? So, historically, when rates are going down and and basically there's not recession, the market goes up 16% 12 months after. Very good. But if there's fears of there's a recession, the market goes down on average 6%. So it depends how you look at things right now. We're in a very unknown territory. We're at all-time highs. The market has been doing amazing over the last couple of years. We have a lot of fears with tariffs, and also we have a market cycle coming up next year of midterm elections. So you have to be cautious in that sense. History does not always repeat itself. It sounds catchy, but you have to be careful with that. And we do know the market works in cycles. So you have to make sure you're taking the right amount of risk that your portfolio and your tolerance has. Now, what is basically happening right now over the next 90 days? So you see this roller coaster? That's what we're expecting. More of a roller coaster. So there's a lot of trade fears right now in the economy. You have to be cautious with that. And what's happening with China that could delay and affect the markets. Over the last couple of weeks, we've seen how a single tweet could have a move and affect the stock markets. There's a lot of tensions still with tariffs on China. So there's not really a clear path when it comes down to that. So we could see a massive downturn out of nowhere because it created more tension or there's more tariffs back in China. So you have to make sure you're in the right places in that sense. Now, on the flip side, that creates opportunity. When rates are going down, there are specific sectors that get benefited by that. So you should be looking at those sectors to spread out the risk and locking in gains of sectors or positions in your portfolio that overgrew over the last couple of years and spread out the risk into other things. And if interest rates stay higher for longer, that could slow down the markets as well. Now, one last thing. When it comes down to tensions all over the world, anything could happen at any time. So that could cause the market to pull back rapidly. And we've seen that over the last couple of years. If you guys remember with Russia, around 4 years ago, if I'm not mistaken, back in 2021, There was a lot of fears with Russia, and then something spiked with Russia and Ukraine, and then the market went down. No one saw that coming. So you have to be careful with geopolitical tension as well. And lastly, it's a great time to make sure your portfolio is aligned with the right amount of risk that you should be taking. Your safe buckets and your risky buckets is a great time to be balancing those things right now. Locking in gains or shifting more money into a different thing due to the fact that there's a lot of uncertainty, there's a lot of unknown in the stock market. Now, housing markets. This is very interesting. And this is a conversation that I have a lot with my biggest clients that they have a bunch of real estate. If we look at the housing supply over the last year, it's up over 8%. It's pretty good. The housing supply right now, as you see here, it's up 8%. This is the highest we've seen over the last couple of years. But affordability, people being able to afford these mortgages with these high interest rates and these prices of the homes right now, there's a massive gap right there. So there's a 50% gap, as you see here on the left, looking at the income that you need to afford these houses and the average income, the median income, I'm sorry, that people actually have right now. So there's a formula that the mortgage brokers use, which is 30% roughly of your income should be used for mortgages. But right now, there's a massive gap behind that because the actual income that you need to qualify for this average price is $120,000, but the median income today in today's market is $80,000. So people are not able to afford these mortgages. That's creating a lot of concerns in the real estate markets. That's creating a lot of tensions in the real estate market. Now, in Miami, we're in a very unique market, but all over the country, as we see Texas, that has gotten affected tremendously. As we see Cape Coral, that has gotten affected tremendously. Tampa as well. So you have to analyze the market that you invest in your real estate or you're looking into buy or sell and see how is everything that's going on right now affecting that specific market. I have met with some clients that they thought they were making a lot of money through real estate, and when you look at their returns, they're making less than 3%. We actually met with a family that was making 1.99% for the amount of money they had tied up in real estate. When we did the numbers, they thought they were making 10%. Nowhere to be found. They were making 1.99%. They knew they could be making more money somewhere else due to the opportunity cost behind that. So sit down, evaluate your properties, do not make an emotional decision, run the numbers. Make sure your money is working hard for you. In this market right now, if you're buying an investment property, it's going to be hard. If you're going to have a profit on a monthly basis while you still have a mortgage, taxes, insurance, HOAs, um, assessments, it's a good time to make sure you're analyzing your real estate portfolio as well. Now, couple last things. As I was talking earlier, the risky buckets over the last couple of years has grown tremendously. It might be a good time for you to sit down with your financial advisor, even if you're not one of our clients. Sit down with someone, one of us, your current financial advisor. Make sure your risky buckets might be a good time to be investing, locking in gains, and switching it to your safe buckets, depending on your goals. What is the purpose behind all this money? Because this bucket right here has grown tremendously over the last couple of years. And as we see the markets, basically, there's a lot of unknowns and there's a cycle that might be happening over the last couple of years, over the next couple of years, I'm sorry. Now, I'll be answering a couple questions because we're wrapping up. And a couple things. I do I do see here a question about taxes. So yes, taxes. So there's a lot of clients that have a lot of their money in the risky buckets that they might have a big capital gain in that buckets. That's a great time to sit down with your financial planner, your financial advisor to see the opportunities of tax planning and basically tax gain harvesting. How can you take advantage of the market the way that it is right now and shifting that money and doing some tax loss harvesting with all the things that you might have, locking in gains, switching to somewhere else and still not paying taxes. There's ways to do so, but you have to make sure you speak with a professional. Now, another question that I have see here. What is the expectation with the market next year? So we're in very unknown territories, like I was mentioning. Market is at all-time highs. There's fears of tariffs. We have interest rates going down with inflation going down. We're in a very unique time. So expectations for next year, just make sure your portfolio is in the right places. If your portfolio is in the right places now when you want to sell high and lock in gains high, and you're spreading out the risk, you're going to be fine. You just have to make sure your portfolio is in the right places, right sectors, right amount of risk that you're taking, and also the right amount of money in the risky buckets and in the safe buckets. Using bonds, REITs, whatever it is at that point, you just have to make sure you're taking the right amount of risk within your tolerance. Now, guys, I have to wrap up. Couple things. For the families that are not our clients, again, we put the families that we serve through an extensive planning process. We look at your retirements and we break down everything that you're doing right now in those 5 areas. We're going to grade you. We're going to see the structure you have everything right now. We're going to see the opportunities of how you're doing things and basically the impact of those things that you're doing right now. What is that going to look like down the line, next 10, 15, 20 years? And then we're going to see basically the opportunity that we could implement to better your wealth. This tool right here, Freedom Plan Process, everyone loves it. Why? Because you could see the challenges that you're facing and you could see basically how you could take your current financial plan and optimize it. Now, here in Guerra, we go through a three-phase process. We got phase number one, which is a discovery process. It takes 1 to 2 meetings where you will learn about us, we will learn about you, your goals, our process, fees, and we're going to be creating this entire freedom planning process for you that will help you see the opportunities and the challenges that you're facing and how can you actually implement different strategies to improve your current situation. If we decide to work together at that point, we go through phase two. Phase two, you cannot do everything in one single meeting. You're going to have different sessions over the next 3 months. You're going to have a session for retirement planning where we're going to do what is called an income gap analysis if you're not retired yet. We're going to map out your spending plan. We're going to put your money and your current financial plan through an inflation scenario. If inflation goes up 5%, 4%, 3%, how would that affect you? Is inflation a concern for you? We're going to create what is called your withdrawal strategy. How are you withdrawing money out of your accounts on a monthly or yearly basis to put you through retirements? Not only because of investments, because depending on where your investments are, you're going to withdraw on a monthly basis, and also asset location. How your investment structure in a way that you're taking money out, not only because of the investments, how they're doing, because of taxes as well, because we have to analyze your tax brackets and take advantage of that as well. Then you're going to have what is called the investment management meeting. That investment strategy meeting is a massive meeting due to the fact that we're going to analyze everything that you have right now and how can we implement things to optimize the way your money is growing. Tax strategy meeting is an amazing meeting. At that point, we're going to look at Roth conversions, bracket maximization. We're going to look at real estate. We're going to analyze everything that you're doing right now. We're going to look at business planning. I love working with business owners because there's a lot that we could do there as well. And the last two correlate with each other: asset protection planning and estate planning. Estate planning is something that a lot of families need to sit down and map out. And phase three, this is actually one of our clients. That's when everything is set up. And then we have what is called quarterly reviews. You will still get portfolio management. You're going to have dedicated wealth advisors. It could be me, it could be someone else. We have a very big team here. But now, the reason why you have a three-phase process is due to the fact that we do intensive planning for the families that we serve. We want to make sure that we look at the boat, things that could possibly sink the boat. We're engineers in that sense. Look at what could sink the boat and how can we patch those areas to make sure the boat floats and you drive that boat as long as possible. So that is the three-phase process for our clients. And here today, I'm one of the ones speaking today. I'm just blessed to be here, being the voice. But it's an amazing team here, guys. What makes us different is due to the fact that we do intensive planning for the families and the amazing team that we have here in Guerra. We have over 60 employees. That's what sets us apart. We're not here to tell you, hey, put all your money into one single investment. That's not what we do. And if you're looking for that, we might not be the best fit. There's different investment vehicles according to your goals. The best investment does not exist. You could create a financial plan, and based on your financial plan, there's going to be vehicles that correlates with that financial plan that will help you accomplish your goals. Now, if you guys would like to have a session, if you're one of our clients, or if you're in your family, you could scan this QR code and then we could book a session where we could analyze how everything is structured right now and how it could help you improve your situation. If you're one of our clients, you could see as well how your portfolio is doing. Has anything happened over your life over the last quarter? Anything, any opportunities? It's a good time to sit down with your financial advisor right now to assess your current picture. But other than that, guys, it's been a pleasure to be here talking to you guys. I love this topic. I'm very passionate about it. And I'll see you here around in the office. And again, it's a great time to meet with your current financial advisor. So again, if you're one of our clients, scan the QR code If you want a new family, scan the QR code so we could go through a freedom plan process and see how we could actually help you improve your current situation. There's always areas of opportunity where we could help new families. But again, it's been a pleasure, okay? Take care.